Today we're going to take a look at putting beginning balances in for a periodic inventory system. This will be similar to what you're doing for projects 2 and 3. So here we have a list. This is similar to what you're going to do for project 2, books and more, and it shows our chart of accounts from December 31st, and that's the end of the fiscal year. You can see the capital and drawing account, so we know that this is a sole proprietor, and therefore by law their fiscal year is from January 1st to December 31st. So this is from the post-closing trial balance of December 31st of last year, and our transactions are going to start for January 1st. We also have a Northeastern Public Company that has a beginning balance that we owe to them. Now in Project 3 is more about sales and accounts receivable, but you would still follow the same type of procedure to get the beginning balances in. So the first thing we're going to need to do is create the company. So we're going to, in our QuickBooks, we're going to create a new company. We're going to use detailed starts. I'm going to call this beginning balance demo. And we'll hit next. Okay. This particular one sells books. So I'm going to use retail shop. But you could use general product-based business as well. Okay, this is a sole proprietorship. The fiscal year has to start in January, so we leave that be. Skip that. And here we want to save the shell of the company into the hard drive. Okay. We only sell products in this case. And we want to record each sale individually. Do you charge sales tax? No, although QuickBooks is going to add on a sales tax payable account anyways, even though we say no. Do you want to create estimates? No. Tracking customer orders? No. Using statements? No. Using invoices? For Project 3, you're going to want to say yes here. But for Project 2, we're not doing sales invoices in here. We're not really doing anything with sales. Managing the bills, do we want to keep track of the bills you owe? Yes. Tracking inventory, do you want to track inventory? No. Because we're on the periodic inventory system for both Project 2 and Project 3. When we get into Project 4, we'll go into the perpetual inventory system, and then we do want to track inventory for that. Tracking time? No. Do you have employees? No. Okay, and you can just say beginning of this fiscal year. Okay, so now here are the income and expense accounts. There are two sales accounts hey, there are two sales accounts here, a regular sales and consignment sales. Okay, so although we're not really using sales in this case, understand that the minute that you say you're selling something, QuickBooks is going to automatically set up a sales account. So this sales that's 401 will automatically be set up. Okay, so we only need to add one more sales account. And so we'll keep this merchandise sales for our consignment sales. We'll just change the name. And in this case, we don't need sales discounts or sales returns and allowances. Now for project 3, you will need those things. Okay? We don't need merchant account fees. All right, then we get into cost of goods sold. Now we have four different cost of goods sold types of accounts. That would be purchases, purchase returns and allowances, purchases discounts, and freight in are all part of the cost of goods sold formula that we learned back in Accounting 101, which is to say beginning inventory plus purchases minus any contra purchases, which is returns and allowances and discounts, and plus freight in. And all of that together is the cost of goods available, and we subtract the ending inventory and we get the cost of goods sold. So all of these four accounts are part of that formula. So they're all going to go in as cost of goods sold types of accounts. Okay, so we have four here, four different ones that are listed as cost of goods sold. So we'll just go ahead, I unchecked that, but we'll just go ahead and keep all four, then we'll just change the name. Okay, and then we have regular expenses. We have three regular expenses: rent, utilities, depreciation. And so I'm going to uncheck advertising, auto, bank, service charges. We'll keep the depreciation. Keep the rent. Keep the utilities. Okay, and then we'll say next. Okay, add the people you do business with. We can go ahead, click on that. It says if you paste from Excel or enter manually, we'll click that. Okay, and we want to put in the vendor that we already have that has that we owe money to, which was Northeast Publishing. Okay, so under name, that's our own made-up name. You can put in, you know, whatever code you want. And then we'll put in Northeastern Publishing, the full name in, and okay, and we don't really need, for our purposes, to put in the rest of this. And so we'll say continue. Now you can put in, you can go through Project 2, figure out who all of your vendors are and all of the companies that we pay a check to, and get them all listed in here. And then they'll at least all be initially set up. And you can do that if you want to. It'll save you a little bit of time. Okay, now here is an enter opening balances, and you can go ahead and here under vendor, Northeast Publishing, under opening balances, we can put the 1,000 and the opening balance date. So this is 1,000 from December 27th. So we'll go back to December 27th of the previous year, and then say continue. Okay, and continue. Okay, the products, you can call this a non-inventory part. And we'll call this books. And books under the description. And the bank account, call that cash. The opening balance of the bank account, of the cash account, is $26,300. And the opening balance date of that would be December 31st of the previous year, the end of the previous fiscal year. Okay, we say no thanks, we're not ordering anything now, and we continue. Okay, and we say start working. Okay, so now you're going to need to go into Edit, down to Preferences, and up in the Accounting and Company Preferences, need to use account numbers, and we can get rid of those warnings. Okay, so let us go into enter bills, and we're going to pull up hold on, don't go into enter bills. Okay, we're going to go into the vendor center, and we're going to double click. Here it shows us the one vendor that we have here. We're going to double click on Northeastern Publishing. Okay, and we're going to go down to payment settings. The payment terms for that was 210 net 30 for that company. We don't need tax settings. The account settings, when we buy stuff from Northeastern Publishing, it's inventory. Okay, and